stragglers coming in. We'll get started soon. A couple things I'd like to mention. Anybody new in here? Like new, first class? Okay. So this is probably not the ideal first class. It's going to be a lot of information, a lot of numbers, a lot of detail. What we've been doing is just going more in depth on this subject of investing. So please don't let this class overwhelm you. And if you would like the PowerPoint on this class as well as class 1 and 2, feel free to reach out to me via email. My card's up there, and I'll send those PowerPoints to you. And I'll also send today's spreadsheet to you as well if you like. So just keep that in mind, because tonight's class is full of a lot of data. And you don't have to just understand everything. You don't have to say, oh yeah, I get that, I get that. Some of it's exposure, and the more exposure you get to it, it's going to make more and more sense. Second point I'd like to make is this Saturday is the Bogleheads meeting. So anybody heard of the Bogleheads? Yeah, so Bogleheads. Basically, it's a group of people that got started many, many years ago following the advice of John Bogle. And it's basically the approach that I teach. And so we meet about twice a year, and we get together, we talk about certain issues. This year I'll give a small class at the beginning, and then we'll discuss issues about life, about investing, about the markets and what they're doing. And basically, it's a chance to sit down with knowledgeable investors and have a conversation. So if you're interested, it's free. It's at 11 o'clock Saturday in the Scholar Space Room at UNI. 11 o'clock. And then after that, by the way, at 3 o'clock at Upper Iowa University, I'll be giving a class on maneuvering around the Vanguard website. For some of you who are at Vanguard maybe, and that website kind of confuses you, or you may not realize just how much information is available there, I will go through a tutorial for an hour and a half, walking you through all the different things that are provided on that website in relation to the investments you have. So again, Bogleheads are at 11, it's 11 to 1, and then 3 to 4:30 is the class on maneuvering around the Vanguard website. Any questions on those two things? Okay, so let's go ahead and get started. Tonight's on asset allocation. Now, this is week 1, asset allocation, and week 2 will be next week. So we're going to spend 2 full weeks on this issue. It's one of the most important issues that you can learn and understand as it relates to your investments. That's going to work. So keep it as simple as possible. It's always a good rule of thumb. When you have your asset allocation, how much you have in stocks, how much you have in bonds, how much you have in cash, and maybe how much you have in real estate. You diversify, you own a lot of it, and then you simply do it at the lowest possible cost. By squeezing out the fees, you increase your returns over time. So try to moderate some of your risk. Try to eliminate where you can. We talked about that last week. But you cannot, in some cases, eliminate all risk. Okay, there's always going to be risk. If you don't take risk, you don't get return. So it's a matter of understanding the risk that you're taking, mitigating where you can, and accepting where you have to. My little clicker's not doing very well. So there are pieces. There are pieces that we're going to put together inside a portfolio that helps that portfolio grow over time with different markets doing different things. In other words, your portfolio should be okay when markets are going down. Your portfolio should be doing well when markets are going up, because those markets are in different markets: bond markets, U.S. stock markets, international stock markets, U.S. real estate. By owning all those asset classes, you can put yourself in the right kind of mix so you have a good, solid return over time. So, big deal here. Focus on the portfolio return. And this is a big deal. So I want to spend a little time on this. So sometimes somebody will call me and say, Finley, my bonds suck. They're not doing well at all. Well, yeah, sometimes that happens. Maybe you'll see international stock going down. Maybe they had a bad year and you think, what the hell? I shouldn't own them. Yes, you should, because you didn't know what was going to go down that year or over that time period, whether it's stocks or bonds or whatever. And when you have high quality bonds in a portfolio and they're going down, that's actually good news, because what's probably going up? Stocks. Yeah. And stocks are going to be the highest returning asset class you're going to have in your portfolio in most cases, in most environments. The bonds are there, high quality bonds. When stocks go down, your high quality bonds go up. So they reduce how far your portfolio goes down in value when stocks are tanking. And they tank on occasion. So the future reflects what you own today. I would make that really clear. You can look at your asset allocation today, and I can give you a pretty close approximation of what that portfolio is going to look like in 10, 20, 30 years. Because we know historically, if you break an allocation down to 50% stocks or 80% stocks, and you own bonds and real estate and maybe some cash, we have a very good idea of what that kind of portfolio does over time. And that includes the fees, making sure those fees are as low as possible. Because fees, again, have a dramatic effect on the final return on your money. You get those two issues down, you are going to be one of the best investors in the world based on your allocations. Know your allocations, be comfortable with those desired allocations, and then do it at the lowest possible cost. At the end of the day, this is all math. It really is. And whether you like math or not, whether you like numbers or not, the numbers can work in your favor if you put it together right. So step one, identify your goals. There's nothing new here. This is the idea that what is this money for? What's the purpose of it? What's it supposed to lead to? Time horizon, right? How long do you need this money? It's not till retirement. It's to maybe death or beyond. And since we don't know death, we got to project a long time, and it could be for our kids or grandkids. Our time horizon could be the money we're leaving behind that we may not need. So if you're investing for, say, 90 years down the road, you'd probably want to have a whole lot of stocks in a portfolio. If your time horizon is 10 years down the road, you might not want to have as much stock. So the time horizon and the length of it helps us dictate just how much stocks we have in a portfolio. Risk tolerance, right? How much can you take? How much can you handle before you freak out? Good way to know that is living through 2008. Who had investments during 2008? Yeah. Was it fun? No. Oh, he said yes. Okay. Well, good for you. It wasn't fun for most of us. It wasn't fun for me. You know, I saw my account just go down, down, down. And while I was feeding it and buying cheaper stock, I still didn't like seeing it go down. It can hurt. It can make you feel stupid. It can make you feel like I'm doing something wrong. But the reality is markets go down. We have to accept that reality as they go back up over time. So it's very important to understand that that's part of the process, and to have a risk tolerance, knowing what you can handle, how far you can handle that. And what I know is an education on this topic can help you better prepare for negative markets, for time periods where stocks or bonds are going down. And of course, your tax situation. What is your current tax situation? Are you a high-income person, a low-income person? Because that's going to help us decide whether to put money in a pre-tax retirement account, an after-tax retirement account. We'll talk about information tonight as it reflects asset allocation. Next week, we'll talk about it as you use it in the real world with real retirement accounts like a 401k and a Roth IRA. And of course, your income needs. If you're in retirement years, how much income do you need from a portfolio? That has a factor. Maybe. Come on, baby. Come on. So identify where all your liquid cash is located. That's not that hard. You got to go find everything. Make sure that you've identified mutual funds that you own, savings bonds, cash in the bank, money in a safe, wherever it's at, identify where it's at. Be sure you identify everywhere, and then you add all that up. What is your grand total? It's incredibly important to know your grand total. What is that number? Because that's the number we use to start to understand how we're going to allocate our investments. Maybe I can get a little help. Maybe my battery's going down. So, I don't know. We'll see. If you're married, consider the spouse. Consider the spouse's money, and how does that fit into this entire family portfolio? Okay, Michelle. So step 3, identify how much you want, right? Now this is your number. How much do you desire to have in stocks versus bonds and cash? And sometimes people say, well, I don't know. Take some time, learn about this subject so you have a good bit of information to help you make that decision. Divide that grand total up by your desired allocations. I have an example here. So for example, somebody's got $400,000 and they've decided they're an 80-20 kind of person. They're going to keep 80% of their money in stocks, 20% of it in bonds and cash. And that's what that would look like. 80% of 400,000 is 320. 20% of 400,000 is 80,000. So we would divide our funds up, our assets within the funds in those numbers. So again, got to have the number up front. You got to figure out your desired allocations, and then you start working from there. Step 4, diversify as much as you can. So this is one of the cardinal rules of investing. It is always true. Don't let anybody tell you it's not. You want to diversify as much as you can. That will reduce the risk of your investments going down in some pretty dramatic ways. Because if you diversify enough, i.e. you own the total stock market index fund, meaning the entire U.S. economy, something may be going down, something else is going up. You want things in your portfolio going up when others are going down. And sometimes people say, well, I just want them all to go up at the same time. Yeah, well, go find a unicorn out there and get yourself a ride, okay? Because nothing goes up, and if you don't want that, because if everything is going up at the same time, guess what? Everything is going to go down at the same time. Do not want that. You want negative correlated pieces. All that means is something that works in a different way than the other piece within the portfolio. Think of it like a seesaw. One side's going up, the other's going down. You want that in a portfolio. So for example, U.S. stocks and U.S. high-quality bonds, they're the seesaw. They tend to go in different directions during different times of the stock market cycle. Every dog has its day. Back to that point, one asset class may be doing poorly now. You don't sell it. You accept that because the next year it could be doing really well. You don't sell the dogs because the next year the dog could be winning the race. You want to be careful of that. And it's easy to get caught up in that. It's very easy. It's easy to think, I want more of that asset class because it did great this year. Well, next year it may not. You grade the portfolio, not the individual asset classes within it. And then you rebalance. Rebalance. So again, I'm an 80-20 guy. I use the threshold method. So if my portfolio gets to 90% stocks, because stocks have been doing so well, or it goes to 70% stocks because they've done so poorly, I'm going to get inside my retirement account, so there's no tax consequences, and I'm going to sell either bonds to get back to 80% stocks, or I'm going to sell stocks if they've gone so far up, getting back to 80%. You sell the high-flying asset class, you buy the dogs to get back to your desired number. It's very rational, it's smart, and it can be hard to do. Because listen to what I just said. You're selling the great stuff that's done so well, and you're buying the stuff that did so poorly. That's what rebalancing is. It works, it's effective, but it can be hard on a psychological point. So you just got to work through that. I use the threshold method. If you want to use the once a year method, nothing wrong with that. You pick a day. Maybe you pick a birthday. And on that birthday every year, if you're an 80-20 person or a 60-40 person, whatever your asset allocations are, you go back in there, you put it right back on that number. Once a year, you get right back to your desired allocation. So once we've done that, right, that's a huge piece all by itself. Then it's just a matter of getting your cost as low as you possibly can. So on that 400,000, for a lot of people, not hard to get a cost of 1.8% a year. When I say not hard, there are many people out there paying 2.5%, 3% or more a year fees on their investments. And they don't even know it because they're buried inside the products, and it's almost impossible at times to figure out how much you're paying. So I used a moderate number, 1.8%. So on 400,000, you're paying $7,200 a year. You don't get a bill for it, but it's coming out. You just don't know how. Another approach, of course, is an all-index portfolio. You own nothing but index funds. Stock index funds, U.S., international, and bond, high-quality bond index funds in the U.S. Maybe real estate index funds as well. In this case, you can get that portfolio down to 0.06. Look at the difference, and it comes to almost $7,000 a year, right? Almost $7,000 a year you're saving in fees by owning similar assets. You just figure out how to own those assets at the cheapest possible cost. Because what you're doing is you're putting more money in your pocket and less money in the financial services industry's pocket. Because that's where that money's going, by the way. It's not going to Netherlands. It's building skyscrapers, and it's increasing bonuses, and it's making other people's salaries much higher. You can't afford to do that, and you shouldn't. So here's an example. That same $400,000 portfolio, you got $400,000. Let's say you're paying 1.8% a year, so you end up with about a 7% return because you didn't quite understand the allocation mix. Here you got $400,000 a year. You're earning a higher rate of return because you knew how to allocate appropriately and you knew how to cut those costs. What's it look like at 7%? And again, so you think 30 years down the road, 400,000 turns into 1.7 million. So this happens a lot, folks. You mention this to somebody, say, "Oh, I'm doing good." You know, they may look at a portfolio, "I'm doing good. Look, what could it have been?" It's a huge difference. So, what is good? Right? What are we comparing ourselves to? Why are we saying something's good when we haven't even compared it to something a whole lot better? And a lot of this is because we just don't know. That's how I got started. I didn't know. I was investing with managed funds, and some guy was helping me and ended up taking a big chunk of my money. I thought I was doing well. I didn't know until I started becoming educated on the subject, as you are, to try to understand, oh, well, that's how they play the game. And if I'm going to do better, I got to play it differently. And then you might think, well, okay, I'll keep money in cash because it's safe. Well, no, it's not safe, right? Look how much worse your cash account would have been at 2% a year for 30 years. So some folks who think cash is king, well, no, it's worth a lot less in 30 years. Inflation eats it up. So the issue is not keeping a lot of money in cash, and the issue isn't trying to time the market, trying to find the right manager. The issue is get your allocations right and do it at the lowest possible cost. And I'll keep saying that until it just sinks in at a deep, deep level, because we know that's the truth. Okay, Michelle? Yeah, there's a delay on this. Just keep hitting. You're okay. Okay, give them time to take that in. It'll work. That's fine. Oh. So here's an example of an allocation mix called the stew. So a friend of mine named Adam Luoff, he's a professional cook. He put this together for me as a way to explain this issue of allocations and a concept called modern portfolio theory. So modern portfolio, we take different asset classes that may be risky, we put them together in one kind of portfolio, and the risky stuff kind of gets outweighed by the less risky, and together it makes for a really good portfolio. You can look at a stew to do the same thing. You could take emerging markets. Emerging markets are a high-risk investment. You know, China, Russia, India, Brazil, really countries that go up and down a lot with their stock markets. And so in this illustration, well, that's a jalapeno. If you were to take a jalapeno, throw it in a stew and serve it, a lot of people wouldn't be too impressed. But if you add other ingredients, pretty soon that jalapeno isn't quite so hot. It kind of works with the other ingredients, the meat, the potatoes, the herbs, the vegetables. By pulling these different asset classes together, we can make a really nice portfolio. We can make a really nice stew. And that's the idea behind modern portfolio theory. Pulling these different asset classes together so your portfolio is going to grow nicely over time. Not always going up, but gradually going up over time. Sometimes a lot, sometimes a little. On occasion, it goes down. So consider Vanguard. So by the way, Vanguard does not pay me. I don't work for them. It may sound like I do. I don't. You pay no loads, so no commissions. Never, ever, ever pay a load. Ever. Like, that should be banned. It should be in the U.S. Constitution. You cannot pay loads. So a load is a commission that goes to a salesman. You go down to your local Edward Jones guy or some other fee-based financial advisor. They're going to charge you a load to pay them, goes to the salesman, and then your money goes to the investment. It's a bad way to do it. You want your money going straight to the investment, getting rid of that middleman who's taking a chunk before your money gets invested. Never, ever pay a load. So a load, again, a Class A load is a load up front, generally 5.75% on a stock fund. Class B load is in the end when you sell it. Class C load is while you own it over time. And you know you have one because you can look at a statement. If you see a letter after, say, a mutual fund that you own, it's like, oh, shit, I got one of those loads. That's not the way to do business. Never pay a load. You want to make sure those fees are low. So fees, the expense ratio. You want to make sure that expense ratio that goes with a mutual fund is as low as you can get it. So an all-index portfolio at about 0.06 is the way to do business. You've squeezed out most of the cost, ending up with most of the return in kind. And you have options at Vanguard. There's multiple index funds that you can buy. And you can transfer high-cost funds there as well. So if you're in the business where you got some crappy funds and you need to get the cost down, you can transfer them to Roth, IRA, traditional retirement account, 401k, IRA, to an IRA that's pre-tax at Vanguard. No tax consequences when you do that. You can also move brokerage accounts over there. You want to be careful of the tax consequences if you sell and then buy. So there's options. And at first glance, somebody might say, oh, it looks like a lot of work. It's worth it. It's worth it. The decisions and the actions you take today have major consequences down the road. Because you're not only just helping yourself, you're putting something in place that's going to help you and your loved ones down the road. See, you get to use this information to make a difference in many people's lives, not just one. As an example, a list of Vanguard stock index funds. What you see in the white is the expense ratio. That's the cost of the fund. So, for example, you put money in the total stock market index fund at Vanguard. It owns the entire U.S. economy, and the cost is 0.04% per year. That's it. That's all you're going to pay. No more, no less. You're going to pay 0.04. It comes out during the year in very small bits, adding up to 0.04%. And that's it. That's what you pay. Those other funds, they all own a total international stock index fund that owns developing and developed countries. So emerging and developed countries all in one fund. If you prefer to own them separately, you can own them as separate individual index funds. There's that real estate index fund. So owning stock in commercial real estate can diversify a portfolio even more. And then a small cap value index. It goes back to the research from Baum and French. Talked about this briefly last week. Where if you overweight a portfolio, you add more of small cap value index. Historically, you've gotten a bigger return on your money. That kind of fund has averaged about 15% a year over long periods of time. The total stock market has averaged about 10% a year. So you take a little extra risk, but you get yourself quite a pop in return. Now, that's the past. There's no guarantee that's going to happen in the future, but there's enough research to show that it might be worth considering adding that portfolio. I do. Any questions on the Vanguard stock funds? So I'm showing you a list. So let's say somebody's, I want to keep this really simple, Finley, and we're going to have worksheets tonight to show you how to break it down, okay? You may not want to own all of these. So the first two, you would generally want to own one or the other. So the total stock owns the 500 index. It also owns mid-sized companies and small companies. So the 500 index is about 75% of the U.S. market, large companies. But it does not hold mid and small companies. The total stock market index does. So try not to overlap. You want to own, if you want to own the total stock market index fund, then own that. You don't need to own more of the 500 index. And again, we'll talk about this as we go through.
Why would the small cap?
Yep.
About twice as much as what the index, the 500 index is.
They're more expensive to trade. It's a smaller market. And so good for him. He's noting it's almost twice as expensive, but in the world of investing, that's incredibly cheap, right? So 04 is rock bottom cheap, and so is 07, right? But small cap is going to be a little more expensive. International, even more so. Real estate as well, because those markets are more expensive to trade, and so that little extra cost comes back to you as the investor. Bond index funds and a money market. So all those first five are bond funds that can provide you income per month, produces interest every month, and they're going to reduce the volatility of a portfolio because they have high quality U.S. government and corporate bonds. And then the bottom one here, the money market, is cash. If you want to earn some money on cash, consider the prime money market at Vanguard, paying about 2.5% a year right now. It's going to go up or down based on what the Federal Reserve does with interest rates. But you can access that money whenever you want it. 2 business days. If you need a chunk of cash, you can send that money to your bank. It'll be there 2 business days. But gives your cash a chance to earn some money. Now, unless you're earning 2.5%, 3% in the bank, which I don't think too many of you are, consider that.
Was that 0.16 of the fee?
Yes, sir. The fee for the money market's 0.16.
So you really be only 0.3.
That, good question. So that 2.48 includes that. So that 0.16 is part of that. You're going to earn 2.48, not 2.48 minus 0.16. Okay? Any questions on these funds? By the way, they meet people in different situations in life. So for example, that intermediate term tax exempt fund, that would be for somebody with high income outside of retirement. They're trying to reduce their federal income tax. That fund will not pay any federal income tax on the interest it pays. So if you're in the high income category and you're trying to hold some bonds outside of retirement, that would be an option. If you're in a lower income bracket, i.e. 12% or 10%, you wouldn't want to do that. You'll be better off with other funds. Yes, sir. Pretty much. So the short-term bond fund is a lower risk bond fund with shorter maturity, so it's not going to pay as much in interest. The total bond is intermediate term, so it's going to pay more interest. It's also going to have a little higher risk. So the longer the maturities, the more they're affected by interest rates. On the plus side, if interest rates go down, total bond will go better for you. If interest rates go up, it'll be hit worse than the short-term bond. So short-term bond fund is just another level above money market. Total bond is another level above that when you're talking about risk. And again, the more risk you take on, you're going to expect higher returns. And historically, that's exactly what plays out. So here's a list of books, right? My second book, What Colors the Sky, is on this issue of investing. I wrote it based on the hundreds of books that I've read. I tried to just take it all, condense it, and put it in an easy-to-read manual that you can apply and understand so you can make the best decisions for your portfolio. These other three are books that I've read that are wonderful. They're all up here if you want to take a look at them after class. They will help you with this whole asset allocation issue, walk you through it. Who's read the 4 Pillars of Investing? Okay, we got a couple. So, and they both know that's not for beginners. So please do not read that book as your first investment book. Okay? Don't do it. Saying that, it's my favorite investment book. I think it's the best investment book ever written, from my subjective opinion. Saying that, read other books as you gather more information, understand the terminology, understand the issue in more depth before you take that on. It's written by a neurosurgeon, smart fella, but he's challenging in the sense that he knows it at such a deep level, it takes time to take it all in. But those are books that I would encourage you to read as time goes on. They will help you in ways that you can't fully appreciate right now. Okay, so before we go into some other information, we're going to go into some asset allocation. Okay, so get ready. Okay, we got a lot of data. Again, this is exposure. I'm trying to show you some different numbers and provide you a perspective of how markets work, how asset classes work, and how you can make sense of them. So what you see here, all the way to the left, you see the inflation rate, which really wasn't tracked. This is going to take us all the way to current time. You see 3-month T-bill, think of cash, treasury bills, 10-year high-quality bonds, S&P 500 largest companies in the U.S., small cap stocks in the U.S. This is the stock in commercial real estate, stock in developed markets like Germany, Canada, and stock in emerging markets, China, Brazil. So what you see in yellow is the highest performing asset class that year. What you see in red is a negative year, right? That asset class lost money from 1 January to December 31st. So I'm trying to orient you right now just to kind of understand what we're looking at. And we're going to start going down this list because these are all going to start showing up because we have tracking systems to show us that research. In this case, you see right now, S&P doing a whole lot better than the other asset classes, but you also see a lot more red, And you see some red even in the 10-year bond. Bonds can go down in value too as interest rates go up in the future. But as you can see, some years in stocks can be wonderful. 30%, 52%, be some big numbers. You're not going to get those kind of numbers in cash, never losing money, but of course inflation is affecting it. Bonds are going to be moderate, going to be up a little higher in cash, but they can lose on occasion. So let's scroll down. We'll keep going a little ways until we start hitting some other asset classes. Okay, we can stop there, Michelle. So now we've added small stocks. We're able to track them. We're able to track U.S. equity and real estate. And now we're at 70s. We're at the beginning of the 70s. And now you see where some other asset classes are beating the S&P 500. In other words, they take turns on top. Every dog has its day. And they don't all sit on the mountain at the same time saying, we won. Somebody's at the bottom going, what the hell? But in this case, you see the returns, again, more negatives when you're dealing with stocks. Go down some further. We'll start bringing in the international stocks here in a minute. Okay, let's stop there, Michelle. So now we've entered all asset classes, and as you see, the yellow is changing. Different asset classes are going up the highest in different time periods. And there's still plenty of red, right? You can't get the big returns without the red. Not going to happen. You can get small returns with no red. You can get a little bit better return with some red, but the bigger returns are going to come with more negative years. Okay, Michelle? We're going to keep going now, and we're going to stop around 2008. Now look what we've got. Let's go to 2008 if you would. Look how stocks did. Look how bad, all the way across the board. But what went up? What went up nicely? High quality bonds. So that's when somebody says, oh, that's why I own those bonds. You see, they weren't sure when the stocks were zooming up. They weren't sure, it's like, why? So somebody, let's say the S&P 500, look at all those years prior to that. There was a lot of people who got out of bonds. They said, oh, I don't need those damn bonds. I got stocks. I'm great. Well, 2008 came around, and that was the time to own bonds. Now, that doesn't mean you jump into bonds and out of stocks. It means you own these asset allocations within your portfolio, as each dog has its day. Okay, Michelle, let's go ahead and take us to real time. And so you come across last year, what was the number one asset class? It's cash. Cash, right? And you think, well, what the hell? So listen, I could go back in time, if I could. I would have put every dollar I had in cash at the beginning of 2018. If I knew exactly what was going to happen, I'd have done that. Because guess what? I'd have come out ahead, better than everybody else. But I didn't do that because I had no idea. And nobody else does either. We shouldn't try to time the market. We shouldn't try to say, oh, I know. No, dude, you don't know. You don't know. Because you don't know where that yellow is going to fall from one year to another. So that's why we own them all. Because what happened? A lot of these went down this year. And if you look, those are actually pretty moderate years. That is normal. by the way. 2008 wasn't normal. Last time that happened, 1929. Anybody experienced both those events? So that might happen in a generation. In other words, you and I may not experience 2008 ever again. It's possible, but I would say it's probably unlikely. Now, are you going to experience negative? Well, sure you are. It happens all the time. Stock market US goes up about 3 out of 4 years, goes down about 1 out of 4 years. And that's not going to be a consistent trend. This is random. There are people who make good money and who try to convince you through a thing called technical analysis. They call them chartists. They look at all those numbers and they tell you what's going to happen next. Like this is some science. This is not science. This is a random collection of returns from year to year. So please don't look at that and say, okay, no, don't do that. Doesn't work. It hasn't worked. It's not going to work. We don't know the future. That's why we own multiple asset classes within a portfolio. Questions on this before we go to the next worksheet? By the way, again, you ask and I'll send this to you. Sometimes it helps to look at these things over time and they can start to make more sense as far as understanding the data. Okay, Michelle, next one. So here's an example of some of those stock funds. Yes, sir.
I did have one question reference spreadsheet.
Okay.
And I didn't see a perfect correlation between going up while stocks went down.
And that is correct. There is no perfect correlation. In other words, stocks and bonds, yes, they work in different correlations over time, but sometimes they go together. And sometimes they go together on the downside. The biggest negative correlation tends to be during the most scariest times. And that's actually when we need them to work. So you want your bonds to be as negative correlated as possible when times are really rocky with the stock market. And that's the kind of response we get with these kind of bonds. So, but that's a very good point. Correlations change over time. They're not set in stone. And when one time something is negative correlated, next time all of a sudden it's kind of together, it changes from year to year and decade to decade. So this worksheet goes into the stock funds. It explains them, gives you an idea of what each stock fund owns, gives you the idea of the cost, of course. That's the symbol, 5-letter symbol that goes with that mutual fund. You can go to Vanguard.com, put in that symbol, and research the fund and better understand it. There's all kinds of information to tell you about that fund and what it owns, what it's done over time. It's going to show you the different returns for the last, 15 years. So Vanguard wants you to be an educated investor. It's transparency. It's like, here you go. Learn as much as you can. Because the smarter you get, you're more likely to come to Vanguard, for example, as you better understand this issue of investing in a portfolio of index funds. So there's a list of stock funds that, again, you can research on your own at any point. The next worksheet, list of bond funds and that money market fund, gives you an idea of what they own. So let's just poke out that total bond, see how that's intermediate maturities. So about 64% of that is U.S. government bonds, and then about 36% are high-quality corporate bonds. Short-term bonds, pretty similar, except the maturities are shorter, so the yield, the interest it pays is less, but the risk is less as well. And then you go down the way and it explains more of those funds with their cost. And just like the stocks, they all have their 5-letter symbol. Yes, ma'am. The what fund?
On the very bottom one.
Yep. So if your marginal tax bracket's 22%, you might consider it. So 22% for somebody single would be, you're looking, maybe 60,000, above 60,000, would be one example. Above 100,000 for a couple, maybe 120. That's 22%. So you're getting close. You start getting the 24% marginal tax bracket and beyond. It could be worth, if you want to hold money in bonds outside of retirement, this could be effective because it's going to save you taxes based on how much you're paying in taxes based off your income. Okay, Michelle. So, more data. So I'll give you some time to take this in. I'll walk you through it. This is those funds and some others at Vanguard and what they actually earned from year to year going back to 2003. So what they earned at that time, what you see in orange is the worst performing asset class. What you see in yellow is the best performing asset class in that given year. So as you go across, you know, you're looking at different things. One thing you see, if you see something with a lot of yellows, well, that means it's a volatile asset class. It's going to go way up and way down on occasion. So you see that with real estate and you see it with emerging markets. Probably the two most volatile asset classes within a portfolio. That's why we put other asset classes in there, modern portfolio theory, to lessen their risk. Not eliminate it, but to dampen it a little bit. And what was the asset class that had the most down years? I don't think so. Cash. Yeah. The federal, think about that. The asset class with the worst years was cash. The cash thing that people think is safe, well, that's what it got you. A lot of years with nothing. So yes, emerging markets had plenty of bad years too, but it also had some great years. I don't see, do we see cash earning, let's see here, 76%? No, don't think so. Emerging markets made 39, 76, 18, 31. So the point here is every dog has its day. I'd like to take you back to 2008. Look at that column. You see how the stock funds did very poorly and what investments did quite well. Your high quality bonds, your short-term bond index and your total bond index. Look how well they did. So some of corporate bonds actually didn't do so great that year, but those U.S. government bonds did. So why is that? Well, when people, traders, and when people are scared, they flee to safety. And the safest place on planet Earth to keep your money is the U.S. government. And I know some of you might think, well, I don't know about that. Okay, so would you rather put that money in the Chinese government? Russia? You want to give it to Russia? Russia bonds? Oh, Venezuela. Want to buy some Venezuela bonds? So, yes, they are. Yes. Okay, so my point here, the U.S. government is the safest place on earth. Whether we may have plenty of problems, but that's where money, and I'm not saying this to U.S. traders, U.S. personnel. People from all over the world move money to U.S. bonds and treasuries when things get dicey, when they get scared. So that's an example of when markets tank, we want to own that kind of asset class. I'd like to highlight a little bit target date funds down here. So target date funds own index funds at Vanguard. They own the total stock index. They own the total international stock index. They own international bond index and total bond index. You notice they're never the worst and they're never the best because it's a combination of bonds and stocks in there. The bigger the number, the more the stocks. The smaller the number, in this case the target retirement income, the less the stocks. So you see, time like 2008, the fund that would do the worst there would be the one with the most stocks. And when investments are going up the following year, the fund that did the best was the one with the most stocks. So when owning a target date fund, the higher you go with the number, specifically at Vanguard, the more the stocks you're going to have, the more volatile. You should see higher returns with stocks over time, lower returns and lower risk with more bonds. And you can get in there and look and see exactly how much they have as far as stocks and bonds at the time that you're looking to buy. That balanced fund you see over there that is highlighted green, that's a 60-40 split that doesn't change. Meaning it's 60% US stocks, 40% US quality bonds, and it stays there. It doesn't do anything. It basically rebalances for you every year to 60-40. These target date funds gradually become more conservative. They own more bonds and less stocks as you start to reach the years at which you're looking to retire. So by understanding the different asset classes and how they've done over different time periods, you can better prepare for when markets go one direction or another. In other words, when markets are zooming up, you go, well, man, that's nice, but you don't get too fired up. You don't think you're a genius. You don't try to borrow money to put money in stock because you know they're probably going to come down too. And when markets go down, you think, well, that's okay. They'll come back up. You've seen this play out before. It's not new. That's how markets work. And again, with more knowledge, you can better prepare for the day-to-day gyrations of stock markets, bond markets all over the world. Questions on that worksheet? Okay, Michelle, next one. So here's some asset allocation options. Three really smart guys. John Bogle, who started Vanguard, Burton Macchia wrote Random Walk Down Wall Street, and Charles Ellis wrote Winning the Loser's Game. Three great men who know a hell of a lot on this subject. They outline the conservative, the moderate, and the aggressive investor. So you consider yourself, and where do you think you fall based off your age? Now, age is only one variable. It's not the only variable to consider with asset allocation. But with this scenario, do you think you're more conservative, more moderate, or more aggressive? Look at your age and go down that way. By the way, there isn't some right or wrong answer here. You got to figure out what's right for you and or a spouse. So I can tell you me, right? Finley is 55 years old. So I fall here, and I'm with Charles Ellis. I love Bogle, I love Macchia, but I'm an aggressive investor in their eyes, which is fine. I acknowledge the volatility of markets. I am more concerned with inflation than I am with markets going up and down. So that's why I'm an 80-20 guy. I have about 20% of my money in bonds and cash and 80% in stocks. And I'll probably stay there for quite some time. But for some people, like, oh, that's too much, Finley, that's too much. Okay, what is right for you? You figure that out. Questions on this worksheet? Okay, Michelle. There are some portfolio considerations. So in this scenario, let's say somebody wants to go 100% stock. So why would you do that? Well, let's say you're 22 years old. You put a little money aside in cash for emergencies. You go balls to the wall. You don't need bonds. You're young. Buy as much stocks as you can at the lowest possible cost. If markets go down, good. When you're young, you want markets to go down. Matter of fact, you're rooting for them to go down because you want to buy as much cheap stock for as many years as you possibly can. Now, some of the older crowd in here, they're saying, hell no. All right? But that's why as you get older, you may own more bonds and cash as time goes on. So breaking it down, those are percentages you could consider as you put together a portfolio using modern portfolio theory. So let's take me, for example, 80%. Maybe I put 40% in the total stock, 20% international, 10% real estate, 10% small cap, and then I put 10% in the bonds and the money market. Done. You do that inside retirement accounts, whether it's an IRA, a 401k, a Roth IRA, maybe a brokerage account. We'll talk about that process next week in doing this in the real world. But you choose your allocations based on your desired big allocation. Yes. You can request it. Send me an email, and I'll send this to anyone. You bet. And you can review it at your own leisure. Yep. Yep. Because that's what this is for, is to think about it. Consider the options. You see the returns. You see the gyrations. What is the right allocate for you right now? Right? Because what it was in the past is irrelevant. What's right now? And then how are you going to change or not change this going forward?
You personally, how often do you review your asset allocation?
A lot, like twice a year. When I say review, I mean I look at it and say, oh, but I actually rebalance, right? So I'm out of whack. I'm at 90% stocks or 70. I may rebalance once or twice a decade. That's otherwise I'm not doing anything. So there's very little to do. As a matter of fact, we want to mess with our portfolio as little as we possibly can. The more we tinker, the worse off we'll be in most cases. Get your allocations right, get your costs down, and let it go. Let markets do their magic, and they can do some amazing stuff. Any questions on that? Okay, Michelle. So here's a really simple portfolio. So some of you might think, that looks a little too complicated. Okay, keep it simple. Same numbers at the top. Now you're just getting two funds. The total stock, which you could consider as a global fund, because the total U.S. stock market, the biggest companies in the U.S., they are conglomerates. They make a lot of money overseas. So if you want to own one stock fund, that's the fund to own. If you want to own one bond fund, there you go. So you could own those two funds and be one of the best investors in the world based on your allocations. That portfolio is going to run you about 0.045 or something. Now you may think, well, is there an easier button? Yes, it's a target date fund. One fund. You pick the number that matches the allocations. You see how the number goes down as the allocation to stocks go down. So is there more than one way to do this? Yes. You just got to figure out what's the right way for you. Knowing your allocations, knowing your costs. Questions on that? Yes. 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 No, you do. You identify exactly what your target retirement fund owns and what percentages, and that goes into understanding your other investments. That's exactly right. And every target date fund, you can get in there and look. On any time period, you can see what it owns. How much in U.S. stocks, international, U.S. bonds, what's it own, and what's it cost. Because there are plenty of target date funds out there that are expensive. So Vanguard has a very inexpensive target date fund. Fidelity has an inexpensive index target date fund. They have a very expensive managed target date fund class. So be careful of that. Yes, sir. Easy button, right? So it's going to cost you a little bit more. It's going to cost like 0.13, which is still really cheap, right? But for some people, it's like, Finley, it's just too damn hard. So this is the easy button. One, there you go. Feed that account until you retire. Really, it can be that simple. And there's nothing, I'm not putting this down. There's nothing wrong with that. I'm an individual index guy because I want to control my allocations more. And I can get my costs about half of this, roughly. My portfolio is at generally 0.07 to 0.06, roughly, right? So this is still incredibly cheap and it's easy. For some people, this works. For others, you'd want to allocate it per the index funds.
How do you figure out, say you have another company's funds that you're paying 0.8 expense ratio, and it's a mid cap and made 25% last year. You get a mid cap from Vanguard, and it made 15%, but it's a whole lot cheaper. How do you figure out
Sure.
which is better to have?
So you look at, and we have a video that I'm going to show on this, but you actually look at that fund and what it owns. So you have to compare mid-cap to mid-cap, and you also have to look to see what benchmarks they're using. So here's a way that some managers cheat. They invest in mid-cap stock, but they have the opportunity to invest elsewhere. So what they do is they take a little extra risk and buy some small stocks. They're riskier, but can get better returns. But they're allowed to do that under their prospectus. So they bump up the returns a little bit, beating their benchmark, like the mid-cap index. And so then when you make that, because they know how this works, then when you look and you say, hey, you beat the index, well, yeah, but that's the wrong index. They have to compare that to a mid and small index to be fair to what they owned. So they play games because they know people, well, they know informed people are looking at those numbers. And then the other thing I would say to that is the odds are so much in your favor with an index fund. So can you find a managed fund that beat an index fund? Yes. Every single year, you're going to find a few that beat it, 15, 20, 25%. That's a guarantee. The problem is that percent, it's going to be about the same every year, but they're going to be different funds. They're not going to be the same funds. So what happens is one year, this managed fund beats an index, and maybe it was all fair game. They're going to market that to the hilt, and they're going to get a lot of money coming in, and then all of a sudden it may underperform, which it normally does, while they got all their money in. People are chasing past performance, which is one of the worst ways to invest your money. Short version of what I just said, the industry plays games with their numbers. And if you're not paying really close attention, it's hard to see how they play those games. And that's, again, the value of some of these books. They will help you see through some of the deceptive marketing and methods that are used to try to convince you to put your money in their funds. Okay, last worksheet here. This is just the way I would put together a portfolio. So if you gave me $600,000 and you said, I'm an 80-20 guy, Finley, well then in this case, and I would put about 40% in the total stock. I put 20% international stock, about 10% real estate, 10% small cap, bond, and cash. That'd be my desired numbers. Is that going to change a little bit based off somebody's individual? Yes, it will. But that's a close approximation. And it can be that simple. Own 6 funds, done. And that portfolio is going to cost you maybe 0.06, 0.07. So again, it doesn't have to be complicated. But it also isn't some precise science. There's a little bit of an art to this. Because these numbers change every single day as markets go up and down. You simply learn to rebalance over time as needed, when one tends to go way up or way down. Okay, so I want to zip to a video here that will hopefully illuminate based on what we are covering here.
Hello, I'm Craig Lazara, Senior Director with S&P Dow Jones Indices, and I'm privileged today to be here with 2 guests, Rick Ferry and Alex Benke. Rick is founder of Portfolio Solutions, a registered investment advisor based in Troy, Michigan, and Alex is with Betterment, again a registered investment advisor and an online broker-dealer. The reason we're here today is to discuss a white paper that they've recently completed called A Case for Index Fund Portfolios. It's really quite a substantial piece of work, and I think you'll enjoy hearing a little bit more about it. But Rick, if I can ask you to start, there's a big concept that underlies all the work you've done, and if you can elaborate a bit on what that is, that might help our viewers.
The idea of the study was to look at
index portfolios as opposed to individual indexes or index funds and how they do in their particular asset class. Because most of the research out there, it looks at, say, the S&P 500 and how an S&P 500 index fund would have done against U.S. large cap actively managed funds, which is important. And the same thing with bonds, the same thing with international. But what we wanted to know was how people would use these index funds in a portfolio. So if you put all these index funds in a portfolio, how would a portfolio of index funds act relative to a randomly selected portfolio of actively managed funds in the same categories? And we run many thousand tests to take a look at that. And we found a lot of interesting conclusions.
It was starting with the individual index fund issues. I mean, we've all seen different estimates. I mean, think of large cap U.S. funds versus the S&P 500, for example, or other examples that are also relevant. What are the odds, if I can put it in those terms,
Sure.
of an investor selecting a mutual fund that will outperform, say, the S&P 500 in the large cap U.S. space?
The odds, if you look at it without survivorship bias, and the word survivorship bias gets a lot of people. It basically means that we don't know today which funds are going to close in the next 5 years. So we're selecting from a universe of funds that are going to either make it 5 years or are going to close. If you look at selecting a fund, say a large cap U.S. equity fund, S&P 500, how many will outperform over the next 5 years, including those that close, it's about 25%. And that's a fairly standard number across almost all the asset classes.
So I'd see also roughly 25%. I refer to success as the likelihood of an investor selecting an active fund that outperforms the relevant index benchmark.
Yes.
The odds of success are, you think, in the 25% range over a 5-year horizon.
That's correct.
At the individual fund level.
At the individual fund level, it's about 25%. Might be a little bit lower than that on bonds, but let's just call the whole universe 25%.
25. Give it 30. It's not very good.
But there's actually another side to this, which is looking at the funds that do outperform. How much do they outperform by relative to the 75% that underperform or go out of business? The underperformers, as a group, underperform by a lot more than the 25% that outperform.
Okay. Important.
So those are the numbers we're starting with.
Okay. Okay. And then what did you do in terms of compiling a database and specifying a study to look at this notion of index fund portfolios versus active fund portfolios?
We wanted to replicate exactly what an individual investor would experience if they're choosing funds for themselves or if an advisor is choosing them for them through time. So we use the CRISP survivorship bias-free database, which includes all those funds that have merged or have died over the time. And we replicated a random portfolio for each of the trials that we did. And if that investor had a fund that closed, we again randomly selected from the funds that were available at that time and took it forward. And at the end, added up all the returns that they had and compared that to the passive or index portfolio.
So for example, if you're selecting U.S. equity funds, you look at the survivorship-free database of active equity funds and select one at random.
Exactly.
And then hold that, and if it happens to close, then you select another one at random.
Exactly.
Okay, and you do that 5,000 times?
So we did it 5,000 times. We looked at the differences in doing it 100 times, 500 times, 1,005. We went up to 50,000 times, and we found that it converged much lower, around 5,000 trials. So we used that in the end.
In other words, the results you got with 10,000 or 50,000 trials were no different than what you would have gotten with 5,000.
So we saved compute cycles.
As cheap as computing power has become, that's still a virtue. So. But that's good. Then how did you select index funds to compare against whatever active funds you were choosing?
So we picked funds that were available over the life cycle that we wanted to look at. We chose some Vanguard, mostly Vanguard investor shares, since those tended to be the longest reigning funds, and took them from each asset class. We also did some analysis with the lower fee share classes like ETFs and Admiral shares, and showed that had a little bit of a benefit as well. But we really wanted to look at the longest time horizon that was possible for a real investable fund.
So the real decision point was to say, I want not an index per se, but a mutual fund that's tracking an index,
Yep.
and I want to go as far back as possible.
Exactly.
Right. So then you, for example, in your first study, as I recall, you compared U.S. domestic stocks, international stocks, and U.S. bonds.
That's right.
So you would have selected an active fund from each of those categories, and compare that against an index portfolio for each of those categories. Rebalancing how often? I mean, every year? Or,
So we didn't actually rebalance
not,
in this
okay.
study. That's been a focus of other research, and we kind of took it out of the equation. We didn't rebalance the index or the actively managed portfolio.
So basically 60% stocks, 40% bonds, and you just hold it for however long the period of the data, 15 years or so, whatever the database accommodates.
Exactly.
Is that fair? Okay.
We didn't think that the rebalancing the portfolio from the previous work that I had done made any difference in this particular study. So we had looked at and we talked about doing annual rebalancing, but when I had done some of the previous work on this, and it didn't change the statistics at all, and so we didn't do that in this particular study. Well, it could be something you could do.
Yeah, makes it's an interesting thing to try. It
Sure.
may not make a difference to the results. Well, what were the results, say of the first study you did where you have U.S. stock, international stock, and U.S. bonds?
So when you look at the index fund universe, the thing that held it back was the international portion. The first total international portfolio that included both developed markets and emerging markets in one portfolio wasn't launched until 1996. So we started with the calendar year January 1st, 1997, and we ran it through 2012. So we had 16 years worth of data. So we gave us the three-fund portfolio: U.S. equities, which we use 40%, international equities, we use 20%, and then a total bond, which followed the Barclays Capital Aggregate Bond Market Index, and that was 40%. So that gave us our first index fund portfolio. And then we went back and we ran the 5,000 simulations, picking from the active funds in each of those categories. And we found that approximately 4 out of 5 of the actively managed portfolios underperformed the index portfolio. The other 20% you could really divide down the middle. About half of those were about equal to the index fund, and perhaps 10% outperformed the index fund portfolio. So then really that's the 10% or the 10th decile that people are going after, but it's such a low probability.
Right. So in other words, is it fair to say, you said earlier, Rick, that in general, the chance of finding an active fund that will outperform an index that's appropriate to its investment style is roughly 25%.
Correct.
And now you're saying in a portfolio of 3 asset classes, the probability is maybe 10%, 10 to 15%.
That's correct. Let's call it 15%.
Okay.
So when you look at each of the individual asset classes, it came out to about 25% outperformed. But when you put the 3 asset classes together in a portfolio, only about 15% outperformed. So you had an extra 10% bump. We call that a passive portfolio multiplier. And this one, for lack of a better way of saying it, is that the portfolio is greater than the sum of the parts, which we found to be very interesting. And it was universal across all the tests that we ran.
So if you add, for example, a specialty class like real estate investment trusts or income sensitive investments, does that help or hurt the results?
Actually, now they all stayed about 85%. If you added more asset classes, so you went from 3 to 5 to 10, we found there was a very slight increase in the probability that the index fund portfolio was going to outperform, but not as large as we actually thought it would be. So if you're starting at 85, as you added 5 asset classes to 10 asset classes, it went up to perhaps 88%. So there was a slight advantage, but not enough for us to actually say, load up your portfolio with all different types of index funds. We didn't call that a portfolio multiplier.
There's 2 kinds of diversification here. There's the diversifying your asset classes, which we know is a good idea, and most people own multiple asset classes in their portfolio, whether they're active or passive. What people also try to do is diversify other things like the manager that they use or the fund company that they're using. And that we found is a really bad idea.
Yeah.
It brings it down, the chances down to 1 in 10 that you'll outperform.
So a way to summarize that
Some of you may recall that was when the wall came down, the Berlin Wall. I was there. I was there 3 weeks before it came down. Didn't know it, but it came down. And I'm a soldier over there, and when that thing came down, you should have seen all these East Germans just flying around all over the place in their little cars that were puffing smoke all over the place. And they would be driving down the road, and I'd be driving down my military vehicle, and they would wave at you. Hey, Mr. American! And it's like, hey, how you doing? They were so excited. I mean, I can almost feel that sense of freedom that they felt even now. It was a sense of just sheer joy that these people had been released from this, what I would call an encampment of holding them in. And as time went on, you know, they adapted. Freedom becomes more of a reality of life and the ups and the downs. But that freedom that those people experienced, you know, they're never going to forget it, ever. Guy by the name of Putin over there, he'd probably love to take those guys and put them right back under the control of USSR, which doesn't exist anymore. But that's not going to happen. I think you'd have to kill those people to make that happen. Because once you really embrace this idea of freedom, then it changes you. It changes you at a deep level. And I tell the story because I think it relates to this subject matter. Understanding this information, understanding it well enough, it can help you see how it can change your life, how it can really bring freedom into your life. And people have experienced that. I've experienced it, and many people have over time as they've dug deep into the subject matter. They feel a sense of freedom that you're never going to take away from them. And so I encourage you to keep coming back, keep learning on this subject until you get to that moment in your life where it's like, I got it. I got it. I get what he was talking about. And from that point on, you are free. Thank you, folks.
I think the 40%.
That was your little for, sir?
Yeah. 40% of 6